Well, good morning, John. It's good to see you again. We're recording this on Wednesday um, because of the Easter holiday coming up. John, often in recent presentations, you've been suggesting to investors that it's a good time to think about locking in high interest rates. We're obviously in an environment where if rates haven't plateaued, then they're very close to plateauing, and expectations, certainly in the market, in the US, in Australia, and elsewhere, is that the next move in rates will probably be a downward drift. So, if this makes sense to try and fix in high rates, where should investors be looking? What are their alternatives? What would you be saying that is on the table for them to pick and choose from?
I like the word drift, Paul. I think that's where we're at. It's not going to be a significant pullback in interest rates, given what inflation's doing at present, which is slowing its decline. So, but there's a few opportunities, and obviously we offer income solutions through our own income fund and our income discrete portfolios managed by Vincent Chin, and targeting 2 or 3% above cash rates and bank bills and TDs. Mostly we can get that by diversifying our investing in that portfolio. We have an alignment with Torica, who's managing through the corporate debt market. And there's other product solutions through third-party managers in asset-backed securities. The core to building income portfolios is obviously spreading of asset classes through passive TDs, bank deposits, and then you move up through corporate debt or hybrids, and then you move into more volatile but higher income streams through property securities and the equity market. So doing that in one fund is probably where we sit in the Climb Income Fund. So that's something to think about for our viewers. The issue I have, taking your point, we've had a good period in the equity market. Markets have rallied quite strongly from October. As always, when markets rally, they're either catching up with value or they're pulling value forward. I think in this instance in Australia, probably there's been a pull forward. I'm very confident about the outlook for Australia, but markets have recovered and reached new highs, which is fine. The economy's bigger. But if you're looking at 12-month and 2-year returns, and you're targeting, depending on your risk profile, between 6 and 8% return, if you're seeing yields, passive returns of 4.5% through TDs and corporate debt around 6%, and you blend them, well, there's 5%, and you're well on your way to getting that targeted rate of return of 6 to 8%. So, our point is that income has always been important in Australia in total returns. There are periods when it hasn't been, when interest rates have been very low. We came out of that in COVID. But right now, you're getting reasonably good yields to come inside a balanced portfolio to meet those targeted returns. And inside pension funds, that's the target return you should be focused upon. Outside super, yes, you might take on more risk and seek double-digit returns, but accept the volatility.
So there's quite a lot in that answer, and we might take each of the asset classes kind of in turn and just drill down a little bit further. So for a cash component, I was looking on Westpac this morning, that's the bank that I use. They are offering something like 4.7 or 4.8 for a 1-year term deposit. Does that seem attractive to you? Do you think that people who are happy to put their money away for a year or so, is that something that could form part of the portfolio?
Well, it's something to talk to your advisor about, obviously. I mean, it depends on your age and your risk profile. Inside super, that would be attractive to someone who's approaching, high pension payout range, so above 80 years old. That's definitely a fairly attractive rate. But knowing that you're going to be paying out more than that in your pension fund because of age, looking at it bluntly, 4.7% with inflation in Australia running just below 4%, but heading towards 3% in the second half of this year, there's a margin there above inflation, which is reasonable. In my recent presentation, I looked at inflation rates for different cohorts. The retiree and the aged care pension recipient, their inflation rate is remarkably 2 or 3% lower than the worker, so the young household sector with 2 kids. So in a chart I produced from the ABS, the inflation rate was 3% lower. Now, as inflation comes lower, Paul, from 4 towards 3, I think the cost of living will be flat, whether you're a retiree or worker. Having said that term deposit rate to me seems reasonable against projected inflation, but we need to see what the government's going to do to fight inflation.
Yeah.
And I think there's an acknowledgement now coming from all quarters, and it supports what I've been saying for a year now, that the government hasn't done enough to fight inflation. And now we have this wage claim going before the Fair Wage Commission from July 1, and it looks like we're going to get 4 or 5% increase again. That's going to start adding to inflation. So watch this space.
Yeah. So if we move up the kind of risk return scale, we come to government bonds. And even though the Fed has been talking about perhaps cutting interest rates towards the latter half of the year, in the US, the 10-year treasuries have been drifting up from, say, high 3s to 4.25 at the moment. In Australia, the 10-year government bond is sitting around 4%. Do government bond funds hold appeal, or do you think that the risk is more that the yield might go higher than this?
I just don't see a lot of capital gain being available in the bond market. Usually you get the capital returns as longer term maturities rally. That's where you get your capital gain. So it's a function of yield movement longer out the yield curve. An active bond manager being able to pick the mispricing and the rallies and avoiding the pullbacks. And I think most active bond managers are avoiding long dated bonds, Paul. I think they see there's danger there. 4.25 is just not enough. Doesn't say it won't rally, because we've had a decade of nonsense in the bond market, and it's going to be very hard for the bond market to work out what fair value is. I just look at it from a overarching view. I just don't see 4% 10-year bonds as being particularly attractive, unless maybe you're 90 years old and don't expect to see the 10 years out. And maybe that's about being rude. That's about who they'd all appeal to. It doesn't really appeal to me. So I think that you're going back to your first point, term deposits at 4.75 under 12 months are much more attractive than government bonds. Now, what's priced off government bonds is corporate debt. And I think you're seeing good quality corporate debt, in that 2-year plus 2 to 3 year duration. And when you're getting 2% higher there than the government bond, that to me is attractive if the credit rating's up there. So just cutting ahead of you there, Paul, go through the asset classes. I think that's much more attractive to corporate debt market.
But it's quite hard for individual investors to access the corporate debt market. So usually they have to do it through a fund or...
Well, they should do it through a fund. I mean, obviously there are brokers who will deal in over-the-counter securities, and they'll break them up. They'll buy parcels and break them up. And I think the risk there is there's not enough diversity for investors. So if you bought 1 or 2 corporate bonds, I think you're taking on more risk than you understand.
Yeah.
So much better to do it through a managed fund.
Yeah.
With multiple investments, like north of 15 to 20 investments in that fund to diversify your credit risk, your duration risk.
That's right. And that diversify corporates and sectors and industries.
Yeah.
On the asset class we haven't mentioned yet is property. So traditionally, people would be in the real estate investment trust market. The Australian REIT market has been quite a high yielding market. Obviously, it consists of lots of different parts. There's office, there's commercial, there's retail, and everyone knows about residential. What are your thoughts about property and going there for yield?
Well, the listed property market corrected aggressively in 23, more so than the broader market, and has recovered better than the broader market as well. So when I talk broad, I talk about the general equity market, the equity market. So big 4, reasonable good recovery, but not back to where we were. In that movement of prices, you get a push up in yield. So we had a significant yield improvement if people were accessing that secondary market and went against the grain or went against the sentiment. Today, most of those property securities against NTA, you'd say they're reasonable. Against comparative yield, there is some yield appearing, which is better than passive yield, so that's okay. But I look more about the longer term outlook, and I maintain the longer term outlook for Australian property remains very good. And I'd still be adding property to my portfolio. The problem we have in the primary market, and the difference between primary and secondary is when you trade units on the stock market, which are already on issue. The best opportunity, apart from market mispricing or sentiment shifts, which we've seen, is the new issues funding, acquisition of property on a 7-year view. Now, we're not seeing a lot of offers. We're not seeing quality property coming to the market. There's no distressed sellers. Sensible or professional managers aren't releasing property. There might be some portfolio changes at the top end, because there always is. The big funds like to move their property around. But in the real sweet spot, that 50 to 150 million range, which I call the sweet spot, where self-directed retirees can access through managers, there's not a lot coming on the market. And I think the outlook's good. Yields are compressed in the best sector, which is industrial. There's no doubt about that. It's very hard to get, like we could 5 years ago, get 8% plus yields on property on industrial. So you're sort of in that semi-commercial, retail, agricultural sectors, big box sectors, but we're just not seeing the offers, Paul. I mean, that's the problem. So I keep on encouraging our clients to stay to the course. You don't need to worry about your property. There will be cycles, but let the fund managers manage their positions and just watch your cash flow coming off those properties. I mean, that's you can't live off the capital gain, but when we're investing in pension, we live off the cash flows, and I think the cash flows will start improving as there's a catch up with inflation through those rental streams.
Yeah, certainly seen a catch up in respect of retail, certainly like the big shopping centres, but office blocks remain quite a troubled market with the work from home. A lot of offices are under tenanted and people just aren't coming into the office. It's one of the hangovers from the pandemic era. Do you think that's going to permanently affect the office prices? Perhaps more in the B grade and not so much the...
we've talked about this, Paul, and look, everyone's got their own opinion. I think it's a cycle which will wear itself out. I mean, work from home, there are repercussions. Forget about the asset values. I mean, that's a sideshow. But the real issue is the mental health issues, which is developing when people try and change their way of living, way of working, and are not prepared mentally for that change. And I think there is increasing evidence that working from home doesn't suit the majority of workers, and people might not like being regimented in terms of how they work. But I think that there is a good aspect to it, that people like and benefit from going to work and engaging with their fellow workers face to face, have a communal attitude, a workplace environment. There's a lot to say about that, which developed over hundreds of years through the industrial cycle of the world. So flipping it on its head, I just caution. Just a side story, interesting, I'm doing a bit of mentoring with a student from Indonesia and just having a chat yesterday. It's just interesting. I think Australians should be aware. I mean, she's a highly educated graduate, and she was telling me that her working hours, I won't mention the two firms, they're international firms, but working in Jakarta, her normal day, Paul, was between 9 a.m. and 1 a.m. And I go, what, the same? 9 a.m., like that incredible working hours, 5 to 6 days a week. Now, I know she had some international exposure through it, but that was not abnormal. And I think Australia needs to get ahead, needs to understand that our work practices, it's good that we can work less if we're highly productive, but if we're not becoming highly productive, then we're creating a false economy, and it'll come through an inflation. It'll come, if we start paying people and they're working from home, or their productivity drops, and then their mental health is affected. I mean, the cost of mental health now in Australia, as we're seeing for the NDIS, is horrendous, and it's about time we started rather than just pushing and pushing and pushing for working from home, work about the real cost of the economy.
John, I'd like to end on the, my favourite sector, maybe not necessarily just for yield, but the share market traditionally has a dividend yield in Australia of about 4.5%. At the moment, the dividend yield, because of the rise in prices, is probably closer to 4.0, but you do get franking credits. Do you think that the dividend yield and investing for yield on the share market makes sense?
Absolutely, but again, we've got Climb Capital. We're paying out 5.4 cents franked, which is about a 6.5% yield frank. So we're about 2% above the market, trading it as a discount to NTA. So I just put a plug in for what we're trying to do to create that yield out of the stock market and some unlisted securities, and we're doing fine. Now, when the market re-rates as it has, the good news is, because we're running a listed investment company, when we realise capital gains and pay tax on it, we're adding to our franking reserves and our profit reserves to allow us to sustain that dividend yield. And, I think listed investment companies, apart from ours, there's a place for those. So, yes, the share market does present a reasonable yield. 4% franked, I think, is probably a line in the sand, frankly, Paul. So that gets you about that 6.5% pre-tax. That's about 2 to 2.5% above inflation is where you want to be. As that inflation rate hopefully falls back towards 3%, then that yield becomes very attractive compared to that, because broader interest rates will come down as well. So, answer to your question, yes, but I think retail investors and people looking for a yield out of the stock market should look at the listed investment company, which is always bagged, but it actually does give you pretty good yield across a whole lot of those companies, including Climb Capital.
Well, thank you, John. I think we might end it there. A lot to think about with the interest rates hopefully at a peak and due to come down later in the year. It is a good time to think about fixing some good yielding investments in one's portfolio. And obviously our advice is always to speak to a professional planner and get some professional and objective advice in that regard. John, thank you very much. And to our viewers out there, we will see you next week.
See ya.